Have you ever seen this happen? A company reports record profits and the stock crashes. Another company misses earnings and the stock skyrockets. Everyone says the news moved the stock. But if that were true, these moves wouldn't make sense. So today, I'm going to show you what actually moves stock prices and why reacting to headlines is one of the fastest ways beginners lose money. By the end of this video, you'll understand how the market really works and how to think like investors instead of newsreaders. Part 1, the big myth: news moves stocks. Let's clear up the biggest misconception first. News does not move stock prices. If it did, markets would be predictable. Good news would always push prices up. Bad news would always push them down. But markets don't work that way. Because by the time you see a headline on Twitter, YouTube, or CNBC, the market has already priced it in. Professional investors don't wait for the news. They anticipate it. So when the news finally comes out, the question isn't, is this good or bad? The real question is, was it better or worse than what investors already expected? Part 2, the only thing that moves prices. Here's the simple truth. Stock prices move because of supply and demand. That's it. If more people want to buy than sell, price goes up. If more people want to sell than buy, price goes down. News doesn't push buttons that magically move prices. News only matters if it changes behavior. So instead of asking, what did the news say? You should be asking, did this change how investors feel about the future? Part 3, expectations move markets. Markets don't trade on the present. They trade on expectations of the future. Let's say everyone expects a company to grow 20% this year. Now imagine the company reports revenue up 15%. Profits up. Sounds good, right? But the stock drops. Why? Because the market was expecting more. Even good results can cause a sell-off if expectations were higher. On the flip side, a company can post terrible results. But if investors expected even worse, the stock can rally. Stocks move based on surprises, not headlines. Part 4, who is actually moving the market? Another thing beginners miss. Most price movement is not caused by regular people. It's caused by institutions, hedge funds, pension funds, algorithms, and trading systems. These players manage billions of dollars. When they shift positions, even slightly, prices move fast. And they're not reacting emotionally to news headlines. They're adjusting based on risk, interest rates, growth projections, portfolio exposure. By the time retail investors react to the news, the big money already moved. Part 5. Why stocks fall on good news. Let's connect everything. Stocks often fall on good news because expectations were already too high. Big investors are selling the news. Future growth looks weaker than expected. This is why chasing hype is dangerous. If everyone is already bullish, there may be no one left to buy. And prices fall not because the company is bad, but because optimism peaked. The market rewards correct expectations, not good stories. Part 6. How beginners should think instead. So if it's not about the news, what should beginner investors focus on? Here's a better framework. Is this company growing over time? Is it profitable or moving toward profitability? Is the stock already priced for perfection? What could realistically surprise investors? Instead of reacting to headlines, think in probabilities. Long-term investors don't trade the news. They position themselves before expectations change. The big takeaway. Here's the one thing to remember. The stock market is not a scoreboard of the present. It's a betting market on the future. Prices move when expectations change, not when news breaks. If you stop chasing headlines and start understanding expectations, you'll already be ahead of most investors. If you found this helpful, hit like, subscribe, and comment expectations so I know to make a follow-up on how professionals spot turning points early. See you in the next one.